Hey, welcome back. Today, we're tackling a really big question, one that affects literally everyone. What actually decides who gets a job and how much they get paid? We're going to unpack some really core economic models to get a handle on the powerful forces that shape the job market. Okay, let's just start with this number right here, 6.0%. Back in 2003, this was the official unemployment rate in the US. You hear a number like this on the news, and it sounds so simple, so definite. But is it really? You probably guessed it, not even close. Behind that one little percentage is an incredible story of constant motion. I mean, every single month, millions of people are finding jobs, losing jobs, or even leaving the workforce altogether. So that number, it's just a snapshot of a market that is always churning. So first things first, we're going to zoom in from that single percentage point. We need to look at this incredible constant motion, this churn that really defines what's going on in the US labor market. So here's a look at the entire US population back in 2003. Now, when economists talk about the civilian labor force, what they really mean is everybody who's either got a job or is actively looking for one. So back then, that was about 147 million people. Everyone else, they're considered out of the labor force. Think about it like a crowded airport. Is it crowded because tons of planes are arriving and leaving right on time and people are just moving through really fast? Or is it crowded because a massive snowstorm just canceled everything and nobody's going anywhere? A high unemployment rate could mean either of those things, a really dynamic market with lots of movement, or a totally stagnant one where people are just stuck. And the scale of this movement is it's staggering. Just look at these averages. Nearly 7 million people leave their jobs every single month. And the flow out of unemployment is just as huge. 44% of people who are unemployed either find a job or leave the labor force each month. This means unemployment is way less like a stagnant pond and a lot more like a fast-flowing river. But you know what? Even these numbers don't paint the whole picture. The official count completely misses millions of people who say they want a job but have just stopped looking, usually because they're so frustrated. These are the discouraged workers, and they really blur the lines between being unemployed and being simply out of the labor force. Okay, so with millions of people constantly moving around, how in the world are wages actually set? Let's start building the first piece of our economic model to really understand this complex negotiation. Well, economists usually point to two main forces. First, you've got bargaining power, right? A worker who's really hard to replace has way more power to ask for a higher wage. An entry-level worker, maybe not so much. And of course, everyone's bargaining power goes up when unemployment is low. The second big idea is something called efficiency wages. This is when companies actually choose to pay more than they have to because they believe it'll lead to a more productive, more loyal workforce. And the most famous example of this? Henry Ford. And this data from his company? It's just incredible. It perfectly shows the power of efficiency wages. In 1913, Ford's annual turnover rate was a mind-blowing 370%. Then he famously doubled wages in 1914, and boom, turnover plummeted to just 16%. Layoffs pretty much disappeared. It wasn't charity. It was a business decision that paid for itself. So economists take all these forces and summarize them in this one wage-setting equation. Let's break it down real quick. The wage, W, depends on three things. First, PE, the expected price level. This is so important because you and I, we care about our real buying power, not just the number on our paycheck. Second, U, the unemployment rate. When unemployment is high, workers have less power, so wages tend to go down. And third, Z. This is basically a catch-all for everything else, like minimum wage laws or unemployment benefits that can push wages up. All right, let's flip the script. We've seen how wages get determined, but what about the other side of the coin? How do firms decide what to charge for their products? We can use a pretty simple model for this. Let's just assume one worker produces 1 unit of something, okay? That means the cost of making that 1 unit is simply the worker's wage, W. Then firms set their price, P, as a markup over that cost. We'll call that markup mu, or mu. And this markup is basically the firm's profit margin. It really reflects their power in the market. I mean, in a perfectly competitive market, firms would have zero power to set prices, so that markup would be zero. Okay, we have our two big building blocks, the way wages are set and the way prices are set. Now, this is the exciting part. Let's put them together and see where the labor market actually finds its balance.
This is where you can really see the tug of war in action. On one side, you've got the real wage that workers want, which, as we said, goes down as unemployment goes up. We call that the wage-setting relation. On the other side, you have the real wage that firms are willing to pay, and that's just determined by their markup. We call that the price-setting relation. The market finds its sweet spot, its equilibrium, right where these two forces balance out.
And this graph shows us exactly how it all comes together. So on the vertical axis, you've got the real wage. On the horizontal, the unemployment rate. See that wage-setting curve, the WS one? It slopes downward because higher unemployment means lower wage demands. Now look at the price-setting line, PS. It's totally flat because the wage firms offer is all about their markup, not unemployment. And that magic point where they cross, that's our equilibrium. This gives us what economists call the natural rate of unemployment.
Now, this is super important. Despite the name, this natural rate isn't fixed in stone. It is not a law of nature. As we're about to see, it's actually determined by policy choices and the whole structure of the economy. Honestly, a better name for it might be the structural rate of unemployment.
Let's run through a couple of examples. So imagine the government makes unemployment benefits more generous. That gives workers more bargaining power, right? That shifts the whole wage-setting curve up. To find a new balance, the unemployment rate actually has to go up. Or what if the government gets less strict with antitrust laws? That lets firms increase their markups, which pushes the price-setting line down. Again, this means firms are paying a lower real wage, and unemployment has to rise to a new, higher equilibrium.
So the huge takeaway here is that this natural rate of unemployment directly corresponds to a natural level of employment. And that, in turn, means there's a natural level of output for the entire economy. This is what economists see as the medium-run equilibrium. And believe it or not, this one equation summarizes that whole story. It shows that the natural level of output, yn, is determined by those structural things we just talked about. That z variable, which includes stuff like unemployment benefits, and mu, the firm's markup.
So, you might be sitting there thinking, wait a minute, if this model determines output, where do things like monetary and fiscal policy fit in? We've talked about them before, so how does that connect? That's a great question.
And here is how it all connects. In the short run, the economy can definitely fluctuate. Changes in demand, like government spending or interest rates, can totally push unemployment above or below that natural rate. But in the medium run, the economy tends to gravitate back to that natural level of output. You can think of the natural rate as a kind of anchor. The economy might drift away from it for a while, but it's always being pulled back. And that leaves us with a really final and I think powerful question. If this so-called natural rate is actually the result of policy choices we make about competition laws, about social safety nets, what does that tell us about our power to change it? It means the structure of our labor market isn't some fixed thing. It's something we build.